Hey everyone, welcome back. We're going deep today into a book you wanted to hear about. It's Frank Gallinelli's What Every Real Estate Investor Needs to Know About Cash Flow. And we're going to try to unlock the secrets to evaluating properties. Like a pro. I'm ready, are you?
Oh, yeah, you bet. One of the coolest things Gallinelli does is he challenges that simple idea of buy low, sell high, which isn't wrong, but he adds this whole other layer of financial understanding to it.
Okay, so he starts off with these four pillars of profit, right?
Yeah.
Cash flow appreciation, loan amortization, and tax shelter. To be honest, when I first read those, I was like, I don't know about this. But then I thought, imagine trying to build like the most stable investment possible. Would you want it to be standing on just one of those pillars?
That's a great point. And exactly, it's like trying to build a table. If you only have one leg, it's going to tip over, right?
Yeah.
You need all four to be strong and working together to support that investment.
So let's say I find this property and it has amazing potential for appreciation. It's in a great area. Everyone's saying it's going to skyrocket in value, but the rent barely covers the mortgage. Is that a red flag?
It could be. Yeah, that's where those pillars come in, right? High appreciation is fantastic, but if your cash flow is negative, you're essentially losing money every single month just to hold on to that property. And so can you afford to wait for that appreciation while you're bleeding cash every month?
That's a great point. I hadn't thought about it like that. And of course, the other two pillars, loan amortization and tax shelter, those would factor into the equation as well.
Absolutely. Loan amortization is that steady paying down of the principal on the loan you have, and it adds to your equity over time. Tax benefits, things like deductions for mortgage interest and depreciation, can shield some of your income as well, and they can sometimes make a less than ideal cash flow situation, maybe a little bit more palatable, but you have to crunch the numbers carefully.
Now, something else that I thought was really interesting in the book is how Gallinelli emphasizes seeing real estate as an income stream, not just bricks and mortar. Can you unpack that a little for us?
Sure. So what he's doing is he's shifting our focus from the tangible asset, the physical building, to the intangible value it can generate. It's kind of a subtle but profound shift in thinking. Instead of getting caught up in the allure of owning this beautiful building, you're prioritizing the potential income it can produce.
So it's like buying a vending machine, right?
Yeah.
You don't really care about the metal box itself. You care about the steady stream of quarters and dollar bills it spits out.
Exactly. And just like you would want to check that vending machine's inventory and maybe its repair history before you buy it, due diligence is crucial in real estate. You got to dig into those financials, examine the leases, scrutinize those tax bills, verify the utility costs, compare recent sales data.
It's like being a financial detective, right? Uncovering the real story behind the property, and sometimes what you find isn't pretty. Does he have some cautionary tales about neglecting due diligence?
Oh, absolutely. He talks about investors who jumped into deals based on gut feelings or, just taking the seller's word for it. And then they discover all these hidden problems later, things like outdated leases with below market rents or unexpected assessments for major repairs. Those can turn a seemingly great deal into a financial nightmare.
Okay, so we've done our due diligence. We're feeling good about the property. Now it's time to really crunch the numbers. And that's where I got a little lost, to be honest, Gallinelli. He throws out all this financial jargon like gross scheduled income, vacancy allowance, gross operating income, net operating income, and my brain is already starting to hurt. Can you help us decode all of that?
Of course. Let's start with the basics. Imagine your property is fully rented, that total potential rental income you could collect. That's your gross scheduled income.
Okay, but in reality, you rarely have 100% occupancy, right?
Right, and that's where vacancy allowance comes in. It's an estimate, based on the market and the property's history of how much income you might lose because of some vacant units.
So you subtract that from your gross scheduled income.
Exactly, and what you get is your gross operating income, or GOI.
So GOI, that's what you actually expect to collect in rent after factoring in some empty units.
Yeah.
But then we still have to account for the costs of running the property, right?
Right, all those things, maintenance, repairs, property taxes, insurance, those are your operating expenses. Subtract those from the GOI, and you arrive at the all-important net operating income, or NOI. I think of this as the pure profit generated by the property.
Interesting. So NOI lets you evaluate the property's performance on its own merits, regardless of how it's financed.
Exactly.
But there's one more term that I keep seeing, and that's APOD, annual property operating data. What's that all about?
Think of the APOD as a yearly financial report card for the property. It's laying out all those key metrics that we just talked about: gross scheduled income, vacancy allowance, operating expenses, and that net operating income showing you how they all fit together.
So it's like a snapshot of the property's financial health.
Yeah.
You can spot trends, compare performance over time.
Yeah, exactly. By analyzing that APOD, you can even start to compare different properties and get a feel for what a healthy financial picture looks like in your market.
Okay, I'm starting to see how all these financial puzzle pieces fit together, but there's this other big concept that Gallinelli talks about, and it's the time value of money. I'll admit, this one kind of makes my brain hurt a little.
It is a little bit abstract, but it's crucial for making smart investment decisions. The basic idea is that money today is worth more than the same amount of money in the future.
Because the money you have now, you could be investing it and earning interest or returns on it.
Exactly. So let's say you're considering two properties. One offers a higher potential return, but it'll take, say 5 years to realize those gains. The other offers a lower return, but you'll see those profits in 2 years. The time value of money says you can't just compare those final numbers directly.
Because that money tied up for 5 years could have been earning you returns elsewhere.
Exactly. You need to discount those future returns back to their present value to make a fair comparison. That's where things like discounted cash flow analysis come in.
Okay, so the time value of money, it's like this hidden factor that can really shift the whole equation when you're comparing different investment options.
hmm
We're really starting to peel back the layers here.
And that's just the beginning. There's so many fascinating concepts in this book that can help you become a really savvy investor.
Well, we're definitely off to a great start, and don't worry, everyone, we'll be back soon to continue our deep dive into Frank Gallinelli's What Every Real Estate Investor Needs to Know About Cash Flow.
Mm.
Welcome back. I'm still thinking about that whole time value of money thing. It can really impact your real estate decisions.
Hmm.
It's like this hidden current that can push you forward or hold you back.
Yeah, it really highlights how real estate investing is a long game.
Yeah.
You have to think strategically, not just about the final payout, but about the opportunity cost of having your money tied up in a property for, years potentially.
Speaking of strategic thinking, let's get back to those investment metrics we touched on earlier, especially the capitalization rate and the debt coverage ratio. They seem like pretty powerful tools for cutting through all the noise and getting to the heart of an investment's potential.
They're like financial x-rays. They let us peek beneath the surface and see the underlying health of a property.
So let's focus on the cap rate for a minute. You mentioned that it's a measure of potential return, but it's not as simple as just chasing the highest number. Can you give us an example of how that could backfire?
Sure, imagine you're looking at two properties with similar asking prices. Property A is a shiny new building in this trendy neighborhood, and it has a cap rate of, say, 10% property. B is an older, more modest building in a stable working-class neighborhood, but with a cap rate of 6%. Which one are you more drawn to?
Well, my gut reaction is to go for property A. That 10% cap rate sounds pretty tempting, but I know it's not that simple. So what am I missing?
Well, that higher cap rate in property A could actually be a sign of higher risk. Maybe the trendy neighborhood is still unproven or rents are inflated, because of some temporary boom property. B, on the other hand, might be in a less exciting area, but it offers steady, predictable income with less risk of those drastic fluctuations.
So the cap rate is like a signal flare. It gets your attention, but you need to investigate what's causing the signal before you jump in.
Exactly. You have to consider the context, the market dynamics, the potential for future growth or decline. A lower cap rate in a stable, established area might actually be a much safer bet than a high cap rate in a volatile market.
This makes me think back to what Gallinelli says about due diligence.
Yeah.
It's not just about verifying the numbers. It's about understanding the story behind those numbers, right?
Absolutely. And don't forget about the debt coverage ratio. That's another really crucial piece of the puzzle. Remember, it tells you how comfortably a property can cover its debt obligations just from the income it generates.
Right. A DCR of 1 means a property's income just covers the mortgage payments. Anything above 1 gives you a cushion of safety. But what happens if the DCR is below 1? Is that an automatic deal breaker?
Not necessarily. It depends on your risk tolerance and your overall investment strategy. Some investors might be comfortable with a slightly lower DCR if the property has, other strong points like high appreciation potential, but it's definitely a red flag that you want to, consider carefully.
So it's all about weighing those risks and rewards and understanding how these metrics fit into your individual goals.
Exactly. And these are just two of many investment metrics that Gallinelli covers in his book. There's also the payback period, cash on cash return, and even more complex analyses like discounted cash flow and internal rate of return.
Wow, it's like we're learning a whole new language. But even just understanding those two, the cap rate and the DCR, feels like a huge step forward.
They're powerful tools. Yeah, but remember, they're just tools. They can help you analyze a property, but they shouldn't replace your own judgment, your market research, and your gut instincts.
That's a good reminder. It's easy to get caught up in the numbers and forget that real estate is ultimately about people, tenants, landlords, neighbors, communities. There's a human element that you just can't capture in a spreadsheet.
Absolutely. And Gallinelli emphasizes that throughout the book, he reminds us that real estate is a local business. It's deeply influenced by, market dynamics, economic trends, even social factors.
So it's not just about crunching numbers in a vacuum. It's about understanding the context, the story of the market where that property is located.
Exactly. He gives a great example of a town that was booming because a new factory opened up. Real estate prices were soaring, investors were flocking in, but then the factory unexpectedly closed a few years later and the whole market crashed. Investors who hadn't considered that inherent risk of relying on a single economic driver, they were left holding the bag.
Yeah, it's a cautionary tale for sure. It
Yeah.
shows how important it is to really understand the market, not just rely on, those surface level trends.
Yeah. He stresses the need to go beyond just looking at recent price appreciation. Look at job growth, population trends, infrastructure development, zoning changes. All these factors can give you a better sense of the long-term prospects of a market.
It's like being a detective, piecing together all the clues to understand the bigger picture.
And don't underestimate the power of talking to local experts, real estate agents, property managers, even longtime residents. They can offer invaluable insights that you won't find in any report or spreadsheet.
That makes me think about how much information is out there these days. We have access to more data than ever before, but sometimes it feels overwhelming. How do we sift through all that noise and focus on what really matters?
That's where discernment comes in. Gallinelli encourages us to develop a critical eye, to question assumptions, and to not be afraid to challenge conventional wisdom.
So it's not just about absorbing information, it's about actively processing it, filtering it through our own understanding of the market and our investment goals.
And being willing to learn and adapt as new information emerges. The real estate market is constantly evolving, and the best investors are those who can, adjust their strategies accordingly.
This is making me feel a lot more confident about approaching real estate investing. It's not about having all the answers. It's about having the right mindset and the right tools to navigate the complexities.
And speaking of tools, there's one more really crucial aspect of real estate investing that Gallinelli emphasizes, and that's negotiation.
Ah, yes, the art of the deal. I'm picturing, those tense back and forth conversations, strategic offers, counteroffers, maybe even a dramatic gavel slam to seal the deal.
It can definitely be exciting, but Gallinelli reminds us that successful negotiation isn't about being, a ruthless shark or a smooth-talking salesman. It's about preparation, clear communication, and finding those mutually beneficial solutions.
So what are some key takeaways from the book when it comes to mastering negotiation? Is it all about, lowballing the seller and hoping they crack?
It's much more nuanced than that. First and foremost, Gallinelli emphasizes thorough preparation. You need to know your numbers inside and out. You need to understand the seller's motivations and anticipate their potential responses.
So it's like going into battle armed with a detailed strategy, your opponent's strengths and weaknesses.
Exactly. He also advises against getting emotionally attached to a property. It's easy to fall in love with a charming building or a prime location, but that can cloud your judgment and lead you to make decisions that aren't financially sound.
It's like dating,
Hmm.
right? You can be attracted to someone, but if they don't align with your values and your goals, it's better to walk away.
That's a great analogy. And remember, negotiation is a two-way street. It's not about trying to outsmart or overpower the other side. It's about finding that common ground and crafting an agreement that works for everyone involved.
So it's more like a dance than a battle.
Precisely. And just like any good dance partner, you want to be respectful, communicative, and open to finding that rhythm that works for both of you.
This is all great advice, but I have to admit I still feel a little intimidated by the whole negotiation process. What if I'm not naturally assertive or I'm afraid of offending the seller?
Well, Gallinelli offers some great tips for building your confidence and honing your negotiation skills. He suggests role playing, different scenarios, practicing your responses to potential objections, and even observing experienced negotiators in action.
So it's like any skill, right? The more you practice, the more comfortable you become. But I imagine there are still times when negotiations get heated or reach an impasse. What do we do then?
He emphasizes staying calm,
Hmm.
focusing on the facts and not taking things personally. It's also helpful to have a clear understanding of your walkaway point, that price or those terms beyond which you're simply not willing to go.
That's a good point. It's easy to get caught up in the back and forth and lose sight of your overall strategy. But what if the seller seems unreasonable or unwilling to compromise?
Gallinelli suggests trying to understand their perspective. Maybe there's a reason they're holding firm on a particular point, and by addressing that concern, you can find a way to move forward.
So it's about being a problem solver, not just a negotiator.
Exactly. And remember, sometimes the best deals are the ones you walk away from. If you can't reach an agreement that aligns with your investment goals and your risk tolerance, it's better to move on and look for opportunities that are a better fit.
This has been incredibly helpful. I feel like I'm starting to grasp the intricacies of negotiation, and I'm definitely less intimidated by the process now.
That's great to hear. And remember, negotiation is a skill that develops over time with practice and experience. The more you engage in these conversations, the more confident and effective you'll become.
We've covered a lot of ground in this segment, from deciphering those investment metrics to navigating the art of negotiation. It's clear that real estate investing is a multifaceted endeavor that requires both analytical skills and interpersonal savvy.
And don't forget the importance of market research, financial planning, and risk management. Those are all crucial pieces of the puzzle.
Well, we're definitely putting that puzzle together piece by piece. But before we get ahead of ourselves, let's take a breather and regroup.
Sure.
We've got one more segment to go, and I'm excited to delve into some of those, nuances and complexities of real estate investing, like tax considerations, risk management, and portfolio diversification. Stay tuned. Welcome back to our real estate deep dive. We've talked about evaluating properties, crunching those numbers, and even negotiating deals, but there's this whole other layer we need to explore, like the stuff that can really trip you up or set you up for success, down the road,
Right. We've laid a really solid foundation, but now it's time to, fine tune our strategy and make sure we're not overlooking any crucial details.
like taxes, for instance. I'll admit, whenever I hear that word taxes, my eyes start to glaze over, but I know we can't just ignore them when it comes to real estate investing.
Oh, you're right. They can be complex, but they're also a huge part of the equation. Gallinelli actually dedicates a good chunk of his book to demystifying the tax implications of real estate investing, and it's really eye-opening.
So it's not just about making money, it's about keeping as much of that money as possible.
Exactly. And the good news is that there are actually a lot of tax benefits associated with real estate, deductions for mortgage interest, property taxes, depreciation, even capital gains. And understanding these can significantly impact your overall return on investment.
Okay, that sounds promising, but I'm guessing it's not as simple as just claiming a few deductions on our tax forms and calling it a day.
Unfortunately not. The tax code can be a bit of a labyrinth, and the rules can change. So Gallinelli really stresses the importance of working with a qualified tax advisor who understands the, intricacies of real estate investment.
Mm.
They can help you navigate those complexities and make sure you're taking advantage of every legitimate strategy.
So it's like having a financial Sherpa guiding you through that treacherous tax terrain. You wouldn't climb Mount Everest without a guide,
Yeah.
right?
Exactly. And just like a good guide can save you from costly mistakes, a knowledgeable tax advisor can save you a lot of money in the long run.
Now let's talk about another potential pitfall, risk. Real estate is often seen as a pretty safe investment, but we all know there are no guarantees in life. How do we approach risk management in a way that doesn't make us too scared to invest at all?
Well, Gallinelli is very realistic about this. He acknowledges that, every investment carries some level of risk, and real estate is no exception.
So what are some of the biggest risks in real estate investing? What should we be prepared for?
Well, there are external factors like, market fluctuations, economic downturns, changes in interest rates, even natural disasters. And then there are property-specific risks like, unexpected repairs, problematic tenants, or zoning changes that could impact the property's value.
It's enough to make you want to bury your money in the backyard and forget about it. But seriously, how do we mitigate those risks without becoming paralyzed by fear?
Well, Gallinelli offers some great practical advice. First, Thorough due diligence is essential. We've talked about this before, but it's worth repeating. The more you know about the property and the surrounding market, the better equipped you'll be to anticipate and manage those potential risks.
So knowledge is power when it comes to risk management.
Exactly. He also emphasizes the importance of conservative financial projections. Don't just base your decisions on the best case scenario factor in potential vacancies, unexpected repairs, even fluctuations in rental income.
It's like building a financial buffer into your plans so you're not caught off guard if things don't go perfectly.
Exactly. And don't forget about insurance. Make sure you have adequate coverage for property damage liability, even loss of rental income.
It's like wearing a financial safety harness while you're climbing that real estate mountain. You might not need it, but it's good to have it there just in case.
And one more thing, avoid over leveraging, taking on too much debt can amplify your returns in a good market, but it can also magnify your losses if things go south.
So it's about finding that sweet spot between leveraging your investments for growth and staying within a comfortable risk tolerance.
Exactly. And that sweet spot will be different for every investor. It depends on your financial situation, your goals, and your personality.
Speaking of goals, Gallinelli talks about portfolio diversification. I remember reading about this in other investment books, but how does it apply specifically to real estate?
He uses a great analogy. Don't put all your eggs in one basket. Diversification is about spreading your investments across different asset classes to reduce your overall risk.
So it's like having a safety net. If one investment takes a hit, the others can help cushion the blow.
Exactly. And real estate, with its unique characteristics and potential for long-term growth, can be a valuable part of a diversified portfolio.
This is all starting to come together. We're not just buying properties, we're building a resilient financial fortress, brick by brick, strategy by strategy.
That's a great way to put it. Real estate investing is a multifaceted endeavor. It requires knowledge, patience, discipline, and a willingness to adapt to those ever-changing market conditions.
But with Gallinelli's guidance, we're equipped with the tools and insights to navigate this complex world with confidence. As we wrap up our deep dive, what are some final words of wisdom for our listeners who are, eager to embark on their own real estate investing adventures?
First, remember that knowledge is your greatest asset. Never stop learning. Read books like Gallinelli's, attend seminars network with experienced investors, and stay curious.
So it's about investing in our own education and surrounding ourselves with a supportive community.
Absolutely. Second, remember that real estate investing is a marathon, not a sprint. It's about building sustainable wealth through careful planning, disciplined execution, and patient growth.
So it's about playing the long game, not chasing those short-term gains.
Precisely, and finally, embrace the journey. There will be challenges, setbacks, and moments of doubt, but there will also be incredible rewards, both financial and personal.
Inspiring advice. Thank you so much for joining us on this incredible deep dive into the world of real estate investing. We hope you've gained some valuable insights and are now ready to take that next step on your own investing journey. Until next time, happy investing.